Let's dive in. Imagine you finally saved enough for a down payment. It's a significant milestone, representing years of hard work and financial discipline. This initial investment is your entry ticket into the world of property ownership, a world filled with potential and long-term rewards on a $500,000 house. This is the property you've been dreaming of, the place where you envision building your future. You put down $100,000, a substantial sum that demonstrates your commitment and investment in this property. And the bank covers the rest. They provide the financial backing that makes your homeownership dream a reality. This partnership allows you to leverage your initial investment and acquire a valuable asset. Congrats, you're a homeowner, a moment filled with excitement and a sense of accomplishment. You now have a place to call your own, a foundation for building memories and creating a secure future, with a mortgage to pay for the next 30 years. This is the financial commitment that comes with homeownership, a responsibility that requires careful planning and consistent payments. That $100,000 is your equity, your slice of the pie. It represents the portion of the home that you truly own, the tangible value that you've invested in the property. The rest belongs to the bank, but your goal is to grow your share over time. By consistently paying down your mortgage and benefiting from property appreciation, you'll steadily increase your equity and build long-term wealth. As you pay your mortgage and your home's value rises, thanks to market trends and increasing demand, your equity grows. This growth is a powerful engine for building wealth, as your initial investment appreciates over time. Fast forward 5 years. Time flies when you're making mortgage payments. Your home's now worth $600,000. The market has been kind and your property has appreciated significantly. You've paid down some of your loan, diligently making your monthly payments, and the market's helped out too, boosting your property's value even further. Now, your equity is much bigger, a testament to your consistent efforts and the power of real estate appreciation. Without you doing much more than living your life and paying your bills. It's a relatively passive way to build wealth simply by owning and maintaining your home. This is the magic of real estate, a unique asset class that offers both a place to live and a powerful investment opportunity. A forced savings plan, ensuring that you're consistently building equity with each mortgage payment, and a leveraged investment, allowing you to control a valuable asset with a relatively smaller initial investment. You put in 20%, representing your initial stake in the property, but you benefit from 100% of the appreciation. This is the power of leverage, where a small investment can yield significant returns. That's how homeownership can unlock real wealth, providing a pathway to financial security and long-term prosperity. Let's break down how this works, examining the key factors that contribute to the wealth-building potential of homeownership. Equity is simple. It's a concept that might sound intimidating at first, but once you break it down, it's surprisingly straightforward. We're going to demystify it for you. It's the portion of your home that you truly own, free and clear. Think of it as your share of the property's value. It represents the financial investment you've made in your home over time. To calculate your home equity, start with your home's current market value. This is what a buyer would likely pay for your home today. Next, subtract the outstanding balance of your mortgage. This is the amount you still owe to the bank or lender. The result of that simple subtraction is your equity. It's the difference between what your home is worth and what you owe. In essence, it's the cash you'd pocket, before taxes and selling costs, if you sold your home today at its current market value. Let's illustrate with an example. Suppose your home is currently valued at $600,000, and let's say you still owe $350,000 on your mortgage. That means your equity in the home is $250,000. That's a substantial $250,000 in wealth that you've built up through homeownership. It's a tangible asset that you can leverage. Home equity acts as your financial cushion, providing a sense of security and stability. It's a powerful tool that can contribute to your overall financial stability and long-term wealth creation. And unlike renting, where your payments benefit your landlord, every mortgage payment you make directly increases your ownership stake in your home. When you rent, your rent payments primarily benefit your landlord. But with a mortgage, each payment actively builds your wealth and increases your equity. Therefore, each check you write towards your mortgage is not just an expense, but a strategic investment in your future financial well-being. Building equity opens up a range of financial options and provides a strong foundation for long-term security. It's more than just a number on a statement. It represents your stake, your ownership in what is likely your biggest and most valuable asset. And that's the real, tangible power and benefit of homeownership. Every mortgage payment chips away at your loan and builds your equity. Early on, most of your payment goes to interest, but a little goes to principal. Over time, the balance shifts. More goes to principal, less to interest. It's slow at first, but it snowballs. By the end, you're paying off the loan fast and building equity quickly. Market appreciation is great, but paying your mortgage is the steady, guaranteed way to grow wealth. It's a disciplined, long-term plan. No get-rich-quick scheme, just reliable growth. Stick with it, and your home becomes a powerful asset. That's how you turn monthly payments into real wealth. Let's see how you can use that equity. So, over the years, you've diligently built up equity in your home. You've made your mortgage payments, watched the market hopefully, and now you have a valuable asset tied up in those walls. Now the question becomes, how do you access that hard-earned equity without the drastic step of selling your beloved home? How can you unlock its potential to fund your dreams or manage life's unexpected turns? Enter the home equity loan, a financial tool designed to do just that. It's essentially a second mortgage, where you're using the existing equity in your home as collateral to secure the loan. This means the lender has a claim on your property if you fail to repay the loan as agreed. Lenders typically let you borrow up to 80 to 85% of your home's appraised value. This percentage represents the maximum amount they're willing to lend based on their assessment of your home's worth and your creditworthiness. But that's not the final loan amount. From that 80 to 85%, you need to subtract what you still owe on your original mortgage. So, in our example, if your home is valued at $400,000 and you only owe $240,000 on your mortgage, you could potentially get a loan for up to $160,000. With a home equity loan, you receive the approved loan amount as a single lump sum payment. You then pay it back with interest over a set period of time, typically with fixed monthly payments. This means you'll need to factor in and add a new, consistent monthly payment to your existing budget. The big advantage of a home equity loan? They usually come with significantly lower interest rates compared to other forms of borrowing, such as credit cards. They also tend to have more favorable rates than unsecured personal loans. Beyond the home equity loan, there's also the HELOC, or Home Equity Line of Credit. A HELOC functions as a revolving line of credit, similar to a credit card, that you can draw from as needed, up to your approved credit limit. With a HELOC, you're only paying interest on the amount you actually use, offering more flexibility. Both home equity loans and HELOCs offer homeowners a way to tap into their home's value to finance big expenses, like home renovations, education, or debt consolidation. But remember, and this is crucial, your house is on the line. These are secured loans, meaning your home serves as collateral. Therefore, it's essential to use this financial tool wisely and responsibly, carefully considering your ability to repay the loan before you borrow. Home equity loans can be a smart move if you use them right. Invest in home improvements that boost your property's value, or consolidate high-interest debt to save money. Funding education or covering major medical expenses can also make sense. But don't use equity for luxury cars, vacations, or shopping sprees. You're risking your home for short-term pleasures. Always ask, will this make me wealthier or more secure? If not, step away from the loan. Protect your biggest asset. Borrowing against your home's equity is a big decision. The upside, access to low-interest cash for smart investments or emergencies. The risk, another monthly payment and the possibility of losing your home if you can't pay. If the market drops, you could owe more than your home is worth. Always leave a safety buffer. Don't borrow to the max. Do the math, budget carefully, and have a clear plan for the money. Shop around for the best rates, and be honest. If you tend to overspend, this might not be for you. Used wisely, home equity can unlock huge financial potential. Used carelessly, it can put everything at risk. Make your move with caution and confidence. Thanks for joining us. Don't forget to subscribe and watch the next video to make your money last.